Welcome to Explain the Charts, where we break down the most important movements in the global markets. Today is April 10th, 2026, and the S&P 500 is facing a complex web of catalysts that have traders everywhere on high alert. The headline news is centered on the Middle East, with investors feeling gloomy about inflation and risk-taking ahead of Saturday's talks with Iran. Government statements suggesting potential military positioning if these talks fail have already caused a 250-point drop in the Dow earlier today. Simultaneously, we have a stark contrast in sector performance, where software and credit stocks are struggling while AI-driven tech is thriving. Meta's release of the Muse Spark AI model has injected a massive dose of optimism into the Magnificent Seven, creating a tug-of-war between geopolitical fear and technological greed. The March CPI report has also reignited the inflation debate, leading some analysts to warn that grocery bills could be the next casualty of the ongoing conflict. Furthermore, Fed Chair Powell has summoned bank CEOs for an urgent meeting, leaving the market guessing about the stability of the financial system. Despite this sobering backdrop, the S&P 500 has managed to maintain its winning week after a temporary relief rally following a ceasefire announcement. The index closed today at 6,816.89, down slightly by 0.11%, but the underlying volatility tells a much more dramatic story. As we look at the SPY daily chart here, the price action over the last 2 weeks has been nothing short of extraordinary. We saw a massive dip on April 7th and 8th, where the price plummeted toward the 480 to 490 range, marking a significant test of long-term support. This crash was largely driven by the war-rattled conditions and the fear that the Fed put is officially off the table. However, look at the candle from April 9th, where the SPY exploded with an 11.18% gain in a single session. This reversal was a classic relief rally as ceasefire rumors hit the tape, reclaiming almost all the losses from the prior 3 sessions. Transitioning to the 1-hour chart, we can see the microstructure of this recovery more clearly. The price action on April 9th shows a vertical ascent, fueled by short covering and dip buying in the tech sector. Notice how the volume surged during the midday hours as the market digested the AI news from Meta. This hourly data shows that the price established a local floor around the 520 level before the parabolic move up. The 1-hour trend is currently bullish, but we are seeing some consolidation as we approach the close of the week. The resistance at 685 is particularly strong, as it aligns with historical peaks seen earlier in the year. Every time we approach this 680 to 685 zone, the selling pressure increases due to the uncertainty of the upcoming weekend geopolitical risks. On the downside, if the Iran talks fail, we need to watch the 650 hourly support level very closely. A breach of 650 could signal a rapid reversal of this week's gains as momentum traders exit their positions. Currently, the RSI on this timeframe suggests we are slightly overbought, which explains the cooling off we saw in the final hours of trading today. Short-term traders should be looking for a consolidation pattern between 675 and 680 to confirm a base for the next leg up. If we hold above 673.50, the bullish structure remains intact despite the minor red candle at the close. The high volume on the green candles versus the low volume on the pullback suggests that buyers are still in control for now. However, the back from the brink status of the market is fragile and entirely dependent on the diplomatic outcomes on Saturday. We are seeing a high degree of correlation between hourly price spikes and news alerts regarding refining margins and fuel demand. Now, let's look at the 15-minute chart, specifically filtering for the price action between April 8th and April 10th to see the Muse Spark effect. During this window, we see the extreme intraday swings where SPY jumped from 655 to over 675 in just a few hours. Notice the gaps in the 15-minute candles. These represent moments where news hit the wires and liquidity vanished. The market was essentially repricing the entire probability of a recession based on the new AI productivity forecasts. On April 9th, the 15-minute trend was so strong that it barely touched the EMA, indicating an aggressive buy-everything sentiment. However, as we moved into April 10th, the slope of the move flattened out significantly. This tells us that the initial ceasefire and AI model news has been fully priced in by the market participants. Key levels on this lower time frame include the 671.50 support, which acted as a pivot point multiple times today. If the price dips below 671 in the pre-market on Monday, we might see a gap down towards 660. Resistance is clearly defined at 681.16, which was the high of the day today before the slight sell-off. The 15-minute volume profile shows that the most significant trading occurred right at the open of the April 9th session. Since then, volume has been declining, which is typical as we head into a high-risk weekend. Traders are essentially getting paid to wait, sitting on cash or defensive positions as suggested by some analysts at BNN Bloomberg. The price action near the end of the day shows a series of lower highs, which could be a warning sign for a short-term reversal. If we can break the 680 level with conviction early next week, the 700 milestone becomes the primary target. Conversely, a failure to hold 670 would be a major bearish signal for day traders. Always look for the volume to lead the price. A high-volume break of either of these levels will dictate the trend for the next week. The current volatility makes it difficult to hold overnight positions without significant hedging. Sector rotation is also visible here as money moved out of software like Fair Isaac and into AI infrastructure. This 15-minute granularity shows that the market is essentially parsing the stability of every new headline. Returning to the daily chart, let's recap the critical levels you need to keep on your radar. The most important resistance level is 685, which represents the gateway to the psychological 700 barrier. On the support side, 653.02 is our primary safety net, followed by the deep value zone of 505 to 520. Looking long-term, the trend is still technically bullish as we have made a higher low compared to the 2024 and 2025 data. However, the risk of a 3-month struggle, as warned by Jeremy Siegel, cannot be ignored if inflation continues to rise. My unbiased prediction for the next 2 weeks is a period of high volatility consolidation between 660 and 690. I believe there is a 60% likelihood of an upward break towards 700 if the Iran talks result in a concrete diplomatic path. Conversely, there is a 40% chance of a retest of the 600 level if military positioning escalates or CPI data comes in hotter than expected. Bullish conditions are reinforced by continued AI adoption and potential interest rate stabilization from the Bank of Canada and the Fed. Bearish conditions are reinforced by the Fed put being removed and the liquidation of baby boomer investments. Watch for the earnings season reports coming up next week, as they will be the ultimate test for these war-rattled stocks. The energy sector, in particular, will be a bellwether for the broader market's health given the oil price shocks. If utility stocks continue their strong start to the year, it may indicate that investors are moving into a defensive posture. Keep an eye on Bitcoin as well, as its signs of a bottom could lead to a broader return of risk appetite in equities. Remember to always check the volume and wait for a candle close above or below these key levels before entering a trade. In this environment, patience is often more profitable than aggression. Markets have been primed for this moment, and the next 48 hours of news will be decisive. Thank you for watching Explain the Charts, and make sure to subscribe for more in-depth analysis. This video is for educational purposes only and is not financial advice. Always do your own research and consult with a professional before making any investment decisions.